Hello and welcome to the weekly commodity market update. I'm Brownfield anchor Will Robinson, joined as always by the University of Missouri's Ben Brown. Hey, Ben.
Hi, Will. Good morning.
Good morning to you. How's your week been going so far?
So far so good. We're down to the final 2 weeks of classes here on campus, and I think everybody's happy, faculty, staff, and students. So it's an exciting time on a college campus.
Well, you got to imagine a lot of those ag students potentially are going to be going back home and hopping into a drill to get some of these plants or crops in once they get out of class.
Yeah, no. I've had several already ask me or send me notes saying that they would miss because they were home helping with planting. And certainly, given the weather we've seen, if any of them get a chance to get in the field, they're not going to have any pushback from me.
So looking at the price adjustment that we've seen over the week, can you give me some of the numbers there?
Yeah, sure can. So we've moved to a new nearby contract. The May contracts are in delivery. So our nearby corn contract for that old crop corn is now July, up 5 cents to $8.03. The new crop corn was up a penny to $7.42. Old crop soybeans in July were down 30 cents to $16.45. New crop soybeans in November down 16 cents to $14.90. Looking at the soybean complex, soybean oil was flat on the week, hovering right around 80 cents. Again, remains at elevated levels, but have seemed to settle down just a little bit. Soybean meal and down $15, just short of $15 per short ton, bringing that product down to $430.90 per short ton. And then the July wheat contract, which is both our nearby and our new crop, down 17 cents to $10.55.
So Ben, can you tell me really what were the highlights that got us to those adjustments?
Absolutely. Starting with U.S. ethanol production, we saw an increase of 26,000 barrels per day last week, up to 963,000 barrels per day. That's a little softer than what we've been the last couple of months, but still at relatively strong levels. New export sales for soybeans, soybean meal, soybean oil, grain sorghum, and wheat were all slightly higher last week than the prior week. Corn was the lone commodity that was down week over week, but just slightly. It was basically flat. U.S. weekly export inspection, so what gets on the boat and goes overseas, was slightly up for corn, grain, sorghum, and wheat, but slightly down for soybeans week over week. Looking at funds and managed money in commodity markets, and I look at the Chicago contracts, we saw managed money traders selling off net positions of corn, soybeans, and wheat across the board last week. And that kind of led to some of that bearish pressure and bearish swings we saw last week. And then last week, the planting progress report up to Sunday showed 14% of the U.S. corn crop planted compared to 7% last week versus 42% last year. Winter wheat ratings continue to decline. The good to excellent combination was flat at 27%, but it was that very poor and poor categories where we saw a combined increase of 4%.
So really, just on that, and that's where I'd like to start the conversation today, is planting progress. It's obviously been slow, well behind last year's pace due to a lot of rainfall from Missouri eastward, and we even saw some rainfall in places that needed it, like Nebraska. But really, where does that set the market up whenever looking at this becoming slowly turning into a weather market?
No, that's a great question. And it's really, so you're right. It's Missouri, Illinois, and Iowa. Those are the three states that I look at right now that I maybe am starting to become a little concerned about getting planted. Missouri was 27% compared to 46% last year. Illinois is 7% compared to 50%. And then Iowa at 9% compared to 62%. So those three states, which Iowa and Illinois are big states, corn-producing states. Missouri is a moderate, what I might call a mid-sized corn-producing state in the Corn Belt. But you add those three together, and that's a lot of corn that is likely going to be planted late. So at this point, it's obvious we're not having an early planting season. It's becoming more likely that we're not even going to have a normal planting season, that we could have a late planting window. And your question is, how does that impact the market? And I think the market is starting to tie some of that in. It's being offset by some bearish factors as well. And so there's some headwinds in the ethanol market as we look out into the future. Even though we've seen some strong export sales by China and other markets, actually getting that product on a boat and heading overseas is just still soft. Corn exports, for instance, of actually what is on the boat and leaving the country is somewhere short of about 100 million bushels. And so 110 million bushels short, and it's just providing some weakness, I think, in the market that's being offset by concerns within the broader market. So my answer, that was a long way of answering your question, Will. I think it's already there to some extent, but the reason we're seeing, only a 5% increase week over week and frankly, relatively flat prices is because some of that's being offset elsewhere in the complex.
So really, is there a certain marker that producers can watch for, and expect more market adjustments? Maybe as we get deeper into May, could that be past the second week of May for corn and maybe close to the end of the month for soybeans?
Yeah, no. So I'm gonna just go back to 2019 because that's we remember the most frequent year in my mind. And 2019 was the year where the Eastern Corn Belt and the Northern Plains just had persistent and consistent rainfall and couldn't get the crop in the ground. And we hit a high for that year, that new crop year in July, and it really took off right around the 20th of May. I would say that's when the market really started to take off, all the way to July. A couple of things to remember, and I guess just takeaways that I have from 2019 is just because there's parts of the country that can't get corn planted does not mean that there aren't other places where they're planting corn that they can get more corn in the ground. And that's certainly what we saw in 2019. Places like Southwest Kansas planted a lot more corn than what they were originally anticipating, just because they saw some of the planting struggles elsewhere. Now, it's hard to make up Iowa and Illinois corn production, but certainly, it could be muted some. So just a reminder that even though we saw the high in the corn contract in July of 2019, and by the time we got to October, November of that year, it had fallen pretty substantially.
So you talked about some underlying macroeconomic factors that are maybe tangled up before the market really starts being dictated by weather and late planting. But one of those is the interest rates, and still watching the inflationary picture there. And there could be some news coming out of the Fed on Wednesday. Maybe an adjustment to that interest rate. Tell me what impact is that having right now?
Oh no, this is so the Fed week is this is a big week. Everybody I think is going to be watching Wednesday afternoon and Thursday morning for news out of the Federal Reserve and their press conference, their 30-minute press conference, and it's going to have, I think, potentially big implications for the market, regardless of what they decide to do. Even if they hold things steady and on planned, which the current expectation by the market and participants is a 0.5% increase in short-term interest rates. Even if that is held constant, I think you're going to have some traders that still feel like that's too short of a move to help tame some of the broader inflation. So, the Federal Open Market Committee has a tall task ahead of them. They'll be meeting this week to decide, just how strong to raise short-term interest rates and how quickly they want to, bring down the $9 trillion balance sheet of the Federal Reserve, which is, again, a tool they use to kind of help control some of the longer term interest rates market set, that are determined by the market, but they use that balance sheet and those more bonds and stuff to kind of manage those long-term interest rates. So they've got a tall task in front of them, because if they increase rates too fast, it could send the U.S. economy into a nosedive. Mm-hmm. If they don't take strong enough action, then they risk inflation getting out of hand like it did, roughly 4 decades ago. So they've got a tall task in front of them, and it'll be interesting to see what comes out of the Fed meeting on Wednesday.
From your perspective, would there be one or the other that would be more detrimental, be making too extreme of a move versus not enough?
Well, that's a good question. I've been relatively critical of the Federal Reserve over the last 6 months, mostly from the standpoint that the economy was heating back up. We were seeing the signals that the U.S. economy was strengthening, and yet we weren't doing anything within the monetary policy to kind of help moderate prices. And that's one of the Federal Reserve's 2 mandates. The first one is to maximize employment. The second one is to moderate prices. I felt over the winter, and talked about it quite extensively in extension meetings, that the Federal Reserve really missed their opportunity to start raising rates then. The challenge is, do they raise them too fast and it just flatlines the U.S. economy? And I think that's my biggest concern, is that we end up in a very strong recession just by increasing interest rates too fast. From an ag standpoint, probably there's two factors here. So the short-term interest rates really feed into operating loans and borrowing capacity of farmers. While not every farmer holds debt or short-term operating debt, quite a few do. And so we have it calculated that it would reduce the national farm income by about 10% if short-term interest rates went back up to a normal 2% interest rate. Now, granted, they're talking about a 0.5 percentage point here that would take it up to basically 1%. So we're not quite at the 2% yet. But then those longer-term rates that are set by the market, we kind of represent those with treasury yields, and the treasury yields up around 3% right now and growing fast. In fact, March and April, I think, was the fastest growth in the treasury rate in decades. And so, that really ties into land markets. And if that starts getting heated too quickly, that could have negative impacts on land values.
Before we run out of time today, I want to talk about one of the things that you brought up early in this conversation. Was you talked about some headwinds hitting the ethanol market. Really, what are those, and how is that impacting the farmers directly?
Yeah, good question, Will. So we have seen strong ethanol production. In fact, the grain crushings report that we just got yesterday for the month of March showed that we were 12% higher on corn crushed for ethanol in March than we were February, and we were 8% higher than what we were in March of 2021. So ethanol has had a very strong year, but there are some headwinds ahead of us. The first one primarily is, summer driving season is upon us, and that tends to be a very busy time for gas consumption and ethanol consumption. But gas prices are about $1.30 higher this summer than they were last year at this time, or 43% higher. And that could deter people's, interest in getting out and traveling. The broader macroeconomic stuff we talked about, inflation with the producer price or the consumer price index being somewhere between 6 and 7%. That's eating into people's discretionary income, kind of could deter their travel interest. We've seen challenges with our ethanol facilities getting rail cars in, whether that's bringing corn to the facility or whether that's taking ethanol away from the facility to some of those coastal markets like California and New York. And then finally, oil producers or refiners have a huge incentive right now to take a barrel of crude oil and turn that into heating oil or distillate fuel rather than gasoline. So if we look out ahead, I don't know if I see softer gas prices coming, potentially maybe in some higher gas prices in the next few months, which would then decrease the amount of ethanol consumed.
All right. Well, thank you, Ben. Definitely a lot of things for farmers to keep an eye on in the week ahead and beyond. Some reports to watch. Ethanol report that comes out on Wednesday. Again, we have a lot of discussion with the Fed and their press announcement that we discussed. That's going out this week. And then also on Friday, we have U.S. ag trade data. So stay tuned for that. As always, I appreciate you joining me, Ben. I'm Will Robinson on Brownfield.